We've been working on for some time a revolving line of credit. And for those of you that are invested in our Fund 3, this is a similar structure that we have in place for Fund 3. And just a quick summary of the terms, and then I'll kind of explain how it works. It's a $50 million line of credit. Will let us borrow between a range of 55% to 65%. In terms of leverage. It has a spread, a rate of SOFR plus 275 to 3%, depending on various metrics in the fund. So that's the range of the interest rate. It has a 2-year term with an extension option, and the initial assets that will be pledged to the facility are really 3 on the previous slide that didn't have debt associated with them, namely Clover, Fairfield, and Osprey Huntsville. So with those, that's really going to take all but one asset in the portfolio where we've effectively have either current debt or the ability to borrow through this revolving line of credit. And we're actually planning, hopefully, to close this either today or tomorrow. And if you're unfamiliar with how it works, it's essentially a line of credit that we can use to really manage a couple different things. We can manage acquisitions. So one way to think of it is as a short-term bridge. So as we're looking to acquire new assets, we can draw on this facility, close those assets, execute our plan, and then go and put long-term fixed rate debt on them. And compared to the cost that you would pay for traditional bridge lender, this is really attractive because the cost of the capital to do that under this structure is much more efficient and much lower than through traditional bridge lenders, which obviously is a big driver of value for investors in the fund. The other nice thing to do is it allows us to really manage our liquidity in a very efficient way. The fee loads on this kind of facility are very low. We're not really paying high entry and high exit fees like you would with bridge lenders. And to the extent that we do something down the road, let's say we refinance a property or let's say we sell a property, we could use those proceeds to pay down amounts outstanding under this facility with no prepayment penalty. So we can add new assets, take assets out very flexibly and very efficiently in terms of cost. So it really provides a lot of benefits to managing both our pipeline and our liquidity within the fund.